And now, broadcasting from Titletown, USA, here's Joe Simon.
I don't think everybody in America understands what this backdoor Roth IRA conversion is all about. I think it's one of the biggest power tools we have in our toolbox that just is not being used. Uh, just discussing this with tax preparers and other financial advisors around the Midwest, around the country, it's talked about by some, but is it really implemented? I think it is something that we need to be aware of and know when to implement it. So we're reiterating some things here today on the podcast. We're talking about this backdoor Roth IRA conversion, sort of a step-by-step today, and I'm going to move very fast. We're going to use a lot of verbiage today and take some furious and fast notes on this. I would encourage you to think about having a discussion with somebody that's experienced in doing something like this, to include your tax preparer and have a great conversation around it. It's a very interesting technique to use. Again, the backdoor Roth conversion. So let's get into it. The last time we discussed the backdoor Roth IRA, we focused on high income earners and how they can navigate these contribution limits. We're going to summarize some things here quickly. First, the mechanics and the strategy behind it. The process, there's a step-by-step contribution approach to this with after-tax funds to a traditional IRA and then converting those funds into a old-fashioned Roth IRA. The Roth IRA, of course, is territory. That is an IRA with dollars that have been taxed and will never, ever again be taxed. Very interesting, very powerful, especially for those of us who think that taxes today in 2026 are on sale. Imagine that. Think about that for a minute. The pro rata rule is something that we want to jot down. The pro rata rule, one of just a few things I'm going to ask you to highlight today amongst all of this, but the pro rata rule is something that's a major point of emphasis. We discussed this in several of my writings and other conversations, how holding other pre-tax IRAs like your simple IRA, your SEP, your non-401ks, and how they can trigger taxes on this conversion. So you have your 401k and you have your personal accounts that are all labeled IRAs. If there's a way in which we can carry this over to this, your employer plan, that would be a better, cleaner way to do that. It doesn't eliminate this idea if you can't do it, but it's cleaner if you can. And we'll talk about that in just a moment here. We talked about the employer. So if we can roll that into your 401k with your active employer, so there's a front door that allows you to bring that in and a back door that allows you without any causes. You're still employed there, but you just want to get in and pick up some of this money and move it now out into another IRA. Keep that in mind, a front and a back door. That transaction is something that we'll talk about a little later in this discussion here. In your 2026 focus, what we want to do is look at specific contribution limits for the upcoming year and how, or this year that we're in, and how we apply based on your age and your filing status. We also want to look at rules of engagement. We touched on at one point, or you should have heard this in other discussions, and made a note of this, is a 5-year aging rule. When you set up a Roth account, you want it to be 5 years old before you get at the money. Regardless of everything else around that, you should have in mind that all of this to say we want to pick this money up, move it to a Roth IRA through a few steps we'll learn about again here. But then that money needs to sit there for 5 years. That's not a product rule. That's a Internal Revenue Service rule based on how Roth IRAs work. We also want to be aware of Medicare premiums and IRMA IRMAA. So if you're 63 years old and you're 2 years out, for example, from flipping the switch and getting onto Medicare, we want to be very cognizant of that time frame because you are in a purple zone for this money that they will look at as possible income earned if you decide to do something like this. So that's called IRMA, IRMAA, that causes dollars that are the minimum amount that someone pays for certain earnings that they report from 63, 64 to 65. At least the rules exist that way for 2026. And we don't want to cause a spike in your earnings in those years leading up to and through turning 65 and what Medicare would consider your earnings being. So something to note there. Lots more discussion on that one. We're not going to dig into that here today. So the tax trap, the traditional IRAs, and the pro rata rule. Here we go. The most critical technical point we discussed is that the IRS views all your traditional monies, traditional IRA monies, like your SEP, like your traditional IRA, possibly even your simple IRA. Not sure on that. You want to check that one out. My notes are showing here that, yes, simple IRA also is included in that. So the point here is you've got all of this pre-tax money that's in these accounts that have not been taxed, and then you're trying to take money, bring it up to that traditional, what I'll call a traditional Roth IRA. So the purest form of a Roth IRA. Let's say you want to max out and you're over age 50, $8,600. Before you do that, the IRS looks at the entire amount that you have in all of your accounts and then backs into what the tax would be. I know, we're not going to get far into that today, but the point is that's how they do it. So if there's a way in which we can pick up all those personal accounts and bring them into, for example, your employer's 401k that you currently participate in, that would be a cleaner way to do it because it zeroes out. It zeroes out the picture that the IRS sees because they don't look at the 401k or the 403b that you might currently be participating in. Pretty cool. The problem is you cannot choose to only convert after-tax portions into that non-deductible traditional IRA, step one, to cross the bridge, step two, over to that Roth IRA, creating that big, beautiful backdoor Roth IRA conversion. So the math is if you have $6,000, for example, of after-tax money and $94,000 in traditional IRA monies, that's $100,000. That's the way the IRS looks at it. Even though you're putting in after-tax dollars at $6,000. The solution is hiding pre-tax money, rolling that over to your company's current company's 401k or 403b if they allow that to happen. That is a beautiful thing because then it zeroes things out. It clears the deck for a tax-free backdoor conversion. Let's look at a case here. Case number one, the high earner has a clean slate. Scenario is the individual is earning $250,000 or more in a year and has no existing traditional IRA. The outcome they want to contribute $7,500, which is the 2026 maximum limit if you're 50 or under. $8,600 if you're 50 or older in 2026 into that non-deductible traditional IRA and immediately converted into a pre-tax growth and no other IRAs. So they're picking up these dollars and they're moving them into that IRA because there's no other accounts that they have. Immediate entry into a tax-free growth vehicle despite being over the direct Roth contribution income limit. Case number two, more on the backdoor Roth IRA conversion. In 2026, someone who's 63, they're maxing out what they can contribute into their current employer's 401k. Could they make an additional non-deductible contribution of any amount of money into the backdoor Roth IRA? Well, yes, you can absolutely contribute to an IRA even if you're maxing out your 401k, but you cannot contribute any amount. You're still bound to the annual IRA contribution limits. Participating in a 401k does not prohibit or prevent you from making a non-deductible contribution to a traditional IRA, the first step in the backdoor IRA process, the backdoor Roth IRA process. However, the IRS treats 401ks and IRAs as separate buckets, each with its own ceiling. It would look something like this. For the tax year of 2026, someone age 63 has significantly higher limits due to the super catch-up provisions and standard age-based catch-up that are available. Your 401k allows you to put a maximum of $37,750 if you are 50 or older. And your traditional Roth IRA then would allow you an additional $8,600, again, if you're 50 or older. The backup Roth, or better yet known as the Backdoor Roth Maximum or Super Roth IRA or Backdoor IRA looks something like this. In this scenario, the most you could move into your Backdoor Roth IRA for 2026 is $8,600. You cannot do any amount, even if you have extra cash. You cannot put more than the 86 annual limit into that traditional IRA to start the process. The 401k link, while your 401k participation does not stop you from making the IRA contribution, it does usually make the contribution non-deductible, meaning you don't get a tax break up front. This actually is exactly what you want to do when you do the Backdoor Roth IRA, as it creates an after-tax basis for the conversion. Is there a way to do more? If $8,600 isn't enough and you make more and you want to save more, check your employer's 401k. Ask them if you can do after-tax contributions. This is different than a Roth 401k contribution. If they do, you could potentially utilize the Mega Backdoor Roth strategy. This allows you to contribute up to $83,250 at age 63 in the year 2026 across all of the 401k sources, your deferrals plus employer match plus after-tax contributions. Those after-tax 401k dollars can then be converted to a Roth IRA or a Roth 401k, effectively allowing you to bypass that $8,600 IRA limit. What was that called again? It was called the Backdoor Roth Maximum. I've heard different names for it. The Mega Backdoor Roth is another one. Mega because we can now reach $83,250 in 1 year, moving from non-taxed money, so it hasn't been taxed yet, and you pay that tax to set up that Backdoor Roth IRA. If I had $90,000 traditional IRA and wanted to make a non-deductible $8,600 IRA contribution to an entirely new account, in this scenario, the IRS views my total IRA balance as $98,600. We talked about that, right? Well, this is how the math works on that. So $8,600 plus $90,000 becomes $98,600 taxable picture before we can take it over to that Roth IRA, even if it's $8,600, because we haven't combined that $90,000 sitting over there in that personal IRA account. We didn't do that for whatever reason. So that enlarges that potential tax picture. Yes, Joe, but I don't want to pick up the full dollar amount. I only want $8,600 going into my new Roth IRA, doing this backdoor conversion. I realize that, but this is the way the math works. They take that $98,600, and remember, we divide that out. $8,600 divided by $98,600, and that gives us that 8.7% that they're going to use as a percentage to tax the money going in. So it's virtually, when we convert the $8,600 to the Roth IRA, I know it's a long way around what seems to be a simple process. The IRS applies that percentage to the conversion amount. So it's 8.7% over $8,600, and the tax-free version of that is $748 going into that new Roth IRA you just set up, and the taxable amount is $7,852. That's how they come up with what becomes the taxable amount before it gets into the Roth. But again, once that's done, it grows and runs free of taxes for the rest of its life as long as you keep it there. And then when you pull it out, there's no taxes on that either. That's the Roth beauty. Once money's inside the Roth IRA, you do not pay more taxes on it. It grows tax-free. Withdrawals are tax-free in retirement. However, to get it there, you would owe ordinary income on that $7,852. Here's a strategy on the reverse rollover. We haven't talked about this yet, the reverse rollover. To avoid this tax hit, some people perform a reverse rollover. If you have an active 401k or 403b at your employer that accepts the incoming rollovers, you could potentially move $90,000 of that pre-tax IRA that you have, those accounts out there, back to your employer's plan if they allow that. Since the pro rata rule generally only looks at IRA balances and ignores 401k balances, same with 403 balances that you're actively participating in, this clears the deck, leaving only $8,600 of non-deductible contribution to the IRA, the Roth IRA. You could then convert $8,600 to the Roth IRA with little to no tax liability. Do you have access to an employer-sponsored retirement plan, like a 401k or a 403b, which could potentially shield this hypothetical $90,000 we're talking about in a personally owned IRA? Here's a question. Is there a maximum amount I could use when doing a backdoor Roth IRA, like $100,000? Is there a ceiling? Once funds are already inside traditional IRAs, whether in past contributions or rollovers from a previous 401k or 403b, there's no maximum dollar amount for the conversion. You can convert $1,000 or $1 million. The only limit is your willingness to pay the tax that year and what it's going to do to your income tax bottom line. Something we need to be aware of. The mega backdoor exception, remember, if your goal is to move significant amounts, more than $8,600, the annual amount right now into that Roth account, like the $100,000 we talked about earlier, you should look into the mega backdoor Roth. This is a separate strategy, happens within a 401k rather than your IRA. If your employer's plan allows you after-tax contributions and in-service distributions, that's the backdoor. It allows you to move money in and move money out freely. Well, there's something to talk about there. The total 401k contribution limit for 2026 is $72,000 or up to $80,000 if you're 50 plus years old. You can contribute your standard elected deferral of $24,500 and then fill the gap up to that $72,000 with that limit with after-tax dollars. Those after-tax dollars can be converted immediately to a Roth 401k or a Roth IRA. So, bottom line there, does your employer allow that, the coming and going of after-tax dollars? Some don't. It's an added cost for their administrator to do that, which they don't necessarily consider. I don't know what the percentage is. In past, I haven't come across a 401k plan where an active participant can bring in after-tax dollars and set them in there. But it's worth an ask. It's worth a check. Lots of questions around that. As you look forward in 2026 in particular, remember the backdoor Roth IRA conversion. It's definitely a power tool that we want to look into, something that we can build off of and really use as what I'd call a power tool to beneficial money. So without further ado, what I always like to say is, have a prosperous day.
You've been listening to the Joe Simon Podcast. Big ideas with powerful stories and real-time solutions. Business succession planning, executive benefits, employee benefits, tax beneficial savings, and more. Remember, information discussed here today is dated and not specific to your situation. Always seek personal counsel from qualified advisors. Joe Simon is a licensed insurance agent in the state of Wisconsin. Licensed to advise on accident and health, life insurance, disability insurance and annuities, as well as qualified long-term care insurance.